Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome back to another episode of the Treasury Update podcast. I'm your host, Brian Weeks, and today I am joined by Paul Galloway, Senior Advisor here at Strategic Treasurer. Welcome back to the show, Paul.
Thanks for having me back. I appreciate it.
Absolutely. Today's episode is titled Investment Policy, Creating and Maintaining an Effective Policy. I'm particularly interested in this, Paul, because we're going to be rising above the level of examining individual investments themselves to the level of investment policy. So I'm particularly keen on hearing what you have to say here. What are, Paul, the primary components of an investment policy?
There's several primary components to most policies that you see out there. These are all really tied to providing the guide rails for making investments. So whether it's short-term or long-term or otherwise, these policies are designed to provide the portfolio managers that have been given the charge for investment mandate to make their investments. So they manage the portfolio within these constraints that are set within the policy. So one of the key areas is around investment objectives. So an investment objective kind of outlines what the goals or the objective of the policy is. What is it you're trying to accomplish? What targeted rate of return or risk profile do you require? How much liquidity do you need? Because there is a certain aspect to that where organizations need a certain amount of liquidity, perhaps more at certain times than others. Another area is around the risk tolerance. So I talked about risk. When we talk about risk, when it is involving an investment portfolio, there's a variety of securities you can invest in. A lot of people consider investments. They might be familiar with mutual funds. They might be familiar with stocks or bonds, but there's a lot more available out there to invest in. You can either do things individually. You can do it through mutual funds that target certain aspects. Perhaps people are familiar with funds that target the S&P 500 is one that is pretty common. You may have fixed income mutual funds. Perhaps in some instances, these could be corporate bonds, it could be government bonds, it could be something where you're looking for something that doesn't have as much risk. So there's a traditional kind of portfolio theory out there around risk and return. And this theory plots a line of risk tolerance and returns. And so things that are seen as less risky, less chance of losing principal investment, you would have a lower return, lower risk. You can move up the risk profile. You may get more risk and more return along the way. But there's a point where if you were to take all available investments that are out there and you plotted it, you would have a curve that would go up and to the right with return being on a vertical line, and then on the horizontal line you would have risk tolerance, what that level is, and you would create this curve. That's what modern portfolio theory talks about, and that you would invest in a portfolio that drew a line tangent to that curve where you get the greatest return. So your risk tolerance kind of gives the portfolio manager where you might fit within those parameters, trying to get the least amount of risk and most amount of return. Of course, there's asset allocation factors that come into play. It may be that you don't want to be invested in too much of a particular credit risk or a particular industry, or maybe names of particular companies that you don't want to be invested in or have a heavier weight in. So you could also, in your policy, you could have a component that talks about diversification within the portfolio. The idea behind diversification is that you can reduce the amount of risk in the portfolio and still get good return or a better return within the portfolio, at least on a risk-adjusted basis. So diversification is another component that's often talked about. You also need to have some kind of way to measure how the portfolio is performing. So you'll have in there, what benchmarks are applicable to the portfolio, how often you want to see reporting on that, what those measurements look like for evaluation. You could also have written content that is, instead of number-based or analytical, it's language that talks about the key market factors that are impacting the portfolio, the position of the portfolio for the future, in addition to the performance overall. Lastly, you need to have a component within your policy that talks about compliance and reporting. I did talk about reporting, but from a compliance standpoint, you want to ensure whoever is managing the portfolio stays within the parameters written inside the policy. So there needs to be some kind of way to check that you're not going outside the guide rails that you put in place within your policy.
What risk management controls should be considered in an investment policy?
Yeah, because I kind of lightly talked about risk. And so the first component that you need to consider is the risk assessment. What is the ability or level of tolerance for risk? Things that are perhaps tied to market conditions, economic factors, or the financial health of the investments that you are making. It could be a government, it could be a specific company, it could be an industry. How risky are you in terms of what you're willing to accept to get a better return? And so you might spell out in detail what those risk parameters are within a risk assessment. You can pull out what those factors would be. The other piece we talked about, diversification. So the spread of investments to help reduce risk. So it could be certain asset classes or sectors within an industry or geographic locations. These all could have an impact on the overall portfolio, and you may position across these various asset classes or sectors or geographic locations depending on what's going on from a geopolitical or economic standpoint on a global basis if your footprint goes outside of the particular country you live within. Another area is around liquidity management. I talked about the need to have cash or the ability to get cash quickly when it's needed. So there'd be a certain level within the portfolio of cash that is either invested in a money market funds or secure funds. It could be government funds or treasury funds. If you're doing a fund versus an individual security, it's something that the principal value of what you're investing isn't going to decline. So your net asset value is essentially fixed at 1. And so you put $1 in, you can get $1 back. You're going to get some kind of return associated with what you have invested in. It won't be near as much as what you make with the other investments that are inside your investment guidelines, your investment policy. However, you're giving up that return to have liquidity, so it's not that your cash isn't being put to work. It is. While it's sitting there idle, it's earning a return on that cash. And so you give up some return to get the safety and liquidity that's needed. Typically, you see liquidity as a small percentage of the total portfolio. It just depends on what the needs are for the organization. Of course, it's always good to communicate with your portfolio manager so that they know ahead of time when you might need an influx of cash, if it would be outside of the normal parameters for what you set within your policy. There are compliance and regulatory adherence that needs to happen. We talked about complying with what's in the investment policy itself, But you want to make sure that you're adhering to any regulatory or laws that are in place in terms of where you're making your investments, as well as any internal policies that you have in place within your organization. And of course, performance monitoring is something else that will help you gauge where the portfolio is at. You can see the return of the portfolio. You can look at it by asset class, geographic location, sector, industry. You can get a gauge for what kind of risk you have in the portfolio. You can also get an understanding of what's going on within the economy itself and what impacts that might have on the portfolio. So it can help you with decision making in the future as you start looking at performance overall. Another area is credit risk management. And so this is what I like to call counterparty risk. So you want to understand what risk is associated with counterparties that you are investing in. And there is an inherent risk with investing in corporates or even governments in some cases. But as you're making those kinds of investments, there is counterparty risk associated with making those. You need to have an understanding what that risk is and how you mitigate it through your investment policy itself. Another consideration for risk management would be around stress testing or scenario analysis. So you can stress test the portfolio under different market conditions. This is particularly insightful for portfolios that are made up of bonds. Bonds behave in a different way than stocks do when it comes to interest rates. And so as we talked about on the last podcast, there is an inverse relationship between interest rates and value of a bond. So if interest rates increase, or the yield on bond increases, the value of the bond decreases. Likewise, as yields decrease, the value of a bond will increase. So there's an inverse relationship. You may want to stress test, scenarios of rate cuts or rate increases if you anticipate there's going to be something in the market. Central bank's going to make a decision around raising or lowering rates. You might want to stress test that and see what happens. Another area for stress testing would be any bonds that are callable. And so if a bond is callable, there is inherent risk that your bond could be called in an environment where there's dropping interest rates. So interest rates have been declining. And let's say you have a bond that's paying, I'm just going to make it up, 8% coupon on that bond. It has a call feature on it and yields are dropping. And if that organization that issued that bond has a call feature and interest rates, let's say they drop down to 5%, I'm just making up numbers. So instead of paying 8%, they could reissue a new bond. If they call the existing bond, reissue a new bond at 5%. They would have a cost savings and debt service to them. So they could call the bond, and then you would have reinvestment risk, meaning you'd have to turn around and find a new investment for the return of those proceeds. The other area would be around governance and oversight. So we talked about adhering to regulatory, but when it comes to the investment decision-making process, there needs to be accountability. You need to understand what the roles are, what the responsibilities are. So governance and oversight is another area that helps mitigate risk and manage risk. And the last area would be around contingency planning. And so contingency plans help address disruption. So your scenario analysis helps you understand outcomes if certain things happen. Well, if something happens, what do you do? Contingent planning helps you manage disruptions in the market or with industries or other things that have impacts on your investments. And so it could be even operational in nature potentially. But whatever happens, you need to have some kind of plan in place so that you can address anything that would be considered a disruption or a potential crisis that could impact liquidity and the ability to access cash when needed or make investments. So those are some areas I think are key from a risk management standpoint. I know I threw a whole bunch of stuff out there, but it's an area that organizations definitely have to keep an eye on, and your investment policy will help you with those particular components.
You mentioned callable bonds. So bonds can be callable just like CDs can be callable, huh?
Bonds, yeah. So bonds, they can. Not all bonds have call features. But if you do have a portfolio that has bonds with call features, the stress test and the scenario analysis can help you with that contingent planning in the instance that things change and bonds get called and you're left with cash, because you'll get paid on the bond, the value of the bond, you'll be paid what the market is dictating for yield on that bond. So you'd be paid for that. However, you do have reinvestment risk. So you have to think about those particular things. Okay, I had something that was giving me 8%. Now the best I can get is 5%. What do I want to invest in? So you got to go out and find that next investment and realize, that the future cash flows that you were getting off that, isn't going to be there anymore. It's gone away. So you got to replace it with something.
Yeah, absolutely. So what risks are typically addressed within an investment policy?
Yeah, some of these items that I'm going to tick off, we've kind of talked about a little bit, but, market risk is one of the primary risks with any portfolio. Is these investments that you make, whether it's fixed income or equity or otherwise, there are market risks inherent with each one of them. Some are affected more than others as things and markets move. It can affect countries, it can affect industries, it can affect regions, particular companies. So there's a lot of things you have to consider when it comes to market risk, how that might impact the value of your portfolio, stock prices, interest rates. It could be currency exchange rates as well. So these risks you need to have something in the policy that addresses market risk. We talked about counterparty risk or credit risk. A lot of organizations have documentation around how, they would call it a credit policy. Your investment policy may refer to a credit policy. Your credit policy could be a component within your investment policy where you stipulate how you monitor or manage counterparty risk. You need to monitor it. This is in particular with bonds, fixed income instruments. Does it mean that for equities that you aren't paying attention to the credit worthiness of an organization? It's a little bit different view in terms of how you monitor the risk for equities relative to bonds, but bonds in particular, counterparty risk is part of it. But when it comes to allocation between equities and fixed income, that counterparty risk still comes into play, because there may be certain names or industries where you don't want to have as much exposure to it, and so you'll limit the amount based on the credit risk associated with a particular organization or industry or sector. And so it doesn't matter if it's equities or fixed income instruments, really. We talked about liquidity risk before. You got to have something in place to help you manage liquidity risk, especially when it comes to instances where there's disruption or a crisis that occurs. You want to make sure you have the right tools in place and guide rails to help you manage liquidity risks that may pop up from time to time. Operational risk. This is, the ability to make investments or sell investments, to have access to cash, your transaction processing, buying and selling, maybe delivering securities, maybe you have a securities lending program. So the ability to move assets around, record keeping, the custody of assets. These are all operational tied risks that you need to consider. We talked about compliance risk. That is something you have to make sure that the portfolio is adhered to in terms of being compliant with the guidelines, but you have regulations, laws, and other internal policies. Or, there could be potential reputational risk or legal penalties associated with not being in compliance from a regulatory or a legal standpoint. So you want to make sure you're in compliance. Concentration risk. So I talked about not having too much within one industry, maybe a region or a particular name. You should talk about concentration within your guidelines so that you don't get over concentrated, or that you keep or maintain the right balance of concentration with certain assets that help provide a better risk-adjusted return within the portfolio. There's, of course, interest rate risks, in particular around fixed income securities. You need to understand what's going on with Fed rate decisions. You need to also understand what's happening with inflation risks. There's no avoiding market economic conditions. They do have impacts on investments. So you gotta have tools within the policy to help you manage those particular risks. Another area is around political and economic risk. So that would be political instability, perhaps economic downturns, changes in government policies, and that happens all the time. Countries are making new policies that have an impact on how they do business within their own country or how they do business with other countries. So understanding what some of those changes are, you need to understand the impact on the investments themselves. We talked about, kind of tied back to the interest rate risk is that reinvestment risk. You have proceeds from called bonds or something else. So you had a return of capital. Oftentimes in those instances when bonds are called, you have to reinvest them at a lower interest rate. So there is this idea or this concept of reinvestment risk. So it's got to be part of your policy, and you have to have a way for managing those risks along the way.
Okay, so let's shift gears a little bit. What kind of reporting is typically completed in an investment policy?
So within your policy, you can dictate the types of reports that should be generated, how often they should be generated, where they go. It doesn't have to be specific names of people. It's probably more generic in terms of things that go to the C-suite, things that go to line managers or other people within the company that have a need to know or understand what's going on within the investment portfolio. And so you can think of the performance reports as being an area that details how the investments are generating return against the benchmarks that you outline within your policy. Are they meeting the investment objectives? That will help with, one, the portfolio manager to understand, are they meeting the expected goals, as well as for the line managers, the C-suite folks, to understand how the portfolio is generating return. It should be also marked against compliance. So there's a compliance component of reporting that needs to happen. Are you staying within the investment guideline tolerance levels in terms of concentration, allocation, types of investments that are being made between perhaps fixed income instruments versus equities, regions, foreign currency? These are all things that need to be reported on from a compliance standpoint. And there's risk management reports. And this might detail the portfolio in terms of market risk, credit risk, liquidity, operational risks, how those are being managed, mitigated. You'll talk about that part in the report. It's going to be tied back to what you have within the investment policy itself. Another area is around asset allocation. That is a component of your compliance, but allocation amongst the various investments. I kind of made a comment just briefly around allocation between, real generic and broad equities and bonds. You might be, at a high level, you might say, oh, I can't have any more than 50% in bonds. In equities, you might say, I can't have any more than 70%. So are you allocating between your bonds and equities appropriately? Are you within those constraints? Another area would be around transactions. The transactions that are made in terms of purchases, sales. Perhaps there could be activity with exchanges. Sometimes there's exchanges that happen. There's corporate reorgs. You could be, in some instances, swapping debt for equity or vice versa, or there could be a merger or an acquisition. So you're sending off one security that you had and you're receiving new securities of the entity that bought the other or the newly merged organization. So there's all kinds of things that happen that you report through your transaction report. There's also cash flow reports that show the inflows, the outflows, perhaps the dividends and interest earned on the portfolio, contributions to the portfolio. It could be disbursements out of the portfolio, fees. So these reports show the movement of the cash and how the portfolio might meet your short-term obligations. And then there's ad hoc reports, and that's simply just reporting that is asked for by folks within the organization that may have specific questions or concerns tied back to the investments themselves, and it could be coming from the C-suite or other line managers within the organization.
Okay, so as we wrap up, let's say we have our investment policy in place. Earlier, you mentioned the importance of making sure that people who are managing the cash are in compliance with that policy. How does a treasurer ensure that?
That's a great question. How do you ensure compliance? Well, you got to do the compliance work. You got to have something to benchmark against. And if your policy isn't clear, it's hard to benchmark against something and ensure that you're in compliance. So, it starts with the policy itself. Then there's the working component of actually complying. So, you need to establish clear guidelines. And so they need to spell out in detail, in some cases, exactly what the expectations are. What are the rules? What are the procedures for managing cash and investments? What's permissible? What's not permissible? What is the risk tolerance level? And what are the requirements for diversification? There also needs to be a certain level of, training and communication that happens. And so training sessions ensure that the team understands the investment policy and any updates to it, because an investment policy is considered a living, breathing document, and it can change over time. So it happens for various reasons, but it can change over time. So you may need to update people on changes to the policy itself. And so you got to be able to communicate that, have, a written in the policy. You have to write out how communication is going to happen, the channels for doing that, and allow for any questions or clarifications in terms of the delivery of the communication. And then, of course, reporting. We talked about all kinds of different reports that you would see come out of, generated as part of the investment policy. So it's monitoring, it's reporting, so you can utilize systems to help you manage the reporting and the compliance aspect. This monitoring and reporting on investment activities doesn't happen just through spreadsheets. Oftentimes, investment teams have complex systems that are in place that help do the monitoring and analysis for them. And those can be leaned upon to cultivate data and report on it. Also, another aspect is conducting internal audits. Review the investment activities, ensure adherence to the policy. If it's an outside manager, go and do manager reviews. Kick the tires, look under the hood. I used to do that for another organization I worked for some years ago. I went out and did manager reviews. I met with the portfolio managers. I talked to the operations team. I asked questions around how they ensure compliance with the policy, and I made them show me an instance of how it works. So you got to go out and you got to do these audits sometime to make sure that they're within compliance. If they're not within compliance, you need to have it stated within the policy reconciliation of that. So rectification of being out of compliance. How long do they have to get back in compliance? What does that look like? What are corrective actions? What are the reporting on the actions that were taken to ensure that they're back within compliance? And so sometimes I had to do that with outside managers. There's also performance reviews. It's a way to evaluate how individuals are doing in terms of managing cash against the benchmarks. Are they meeting the objectives? Are they within the policy? Or are they meeting the organizational goals? Compliance checks should be established to ensure that all the investment activity is adhering to local laws, regulations, and company internal policies.
All right. Well, thank you for your insights today, Paul, on investment policy.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.